If you're a contractor doing $1 million, $2 million, or $5 million a year, and you still feel like there's never enough money in the account, this video might explain exactly why. Today I'm going to show you how to read your income statement so you can finally understand where your profit is going and how to keep more of it. So let's get into it. Hey everyone, my name is George. If you're new to the channel, we talk all things accounting for contractors here. Most contractors don't have a revenue problem, they have a clarity problem. They don't understand what their income statement is actually telling them. So today we're breaking down the income statement in plain English. And by the end of this video, you'll know exactly what to look at, what actually matters, and how to spot problems before they crush your profit. So what is an income statement? Also called the profit and loss statement, answers one simple question. Did you make money or not? That's it. It shows revenue minus expenses equal profit. But here's the problem. Most contractors only look at the bottom line. That's like only checking the scoreboard in the third quarter. You need to understand the sections in between and the other things that can impact your cash. Let's start at the very top of the income statement. You'll see revenue. For contractors, this usually includes contract income, change orders, service work, maybe materials markup. But here's the first mistake I see a lot. Contractors can confuse revenue with cash in bank. A lot of times revenue is what you've earned or billed, not necessarily what you've collected. So if you billed $200,000 this month but only collected $120,000, your P&L will still show $200,000 for the month. But revenue alone doesn't mean anything without understanding cost of goods sold. So right under revenue, you will also see cost of goods sold, also called direct job costs. This includes job materials, subcontractors, direct labor, equipment rentals, permits, and job-specific expenses. This is the cost to actually produce the work. Now here's where things get serious. Revenue minus cost of goods sold equals gross profit. This is your first major metric. If you're doing $1 million in revenue, but your direct job costs are $800,000, your gross profit is $200,000. So that's a 20% margin. For most construction companies, you want to see margins somewhere between 25 to 50%, depending on your trade. If your gross margin is anywhere below that, you don't have a sales problem necessarily, you have a job costing problem. One big contractor mistake I see is that a lot of them don't separate direct job costs from overhead. They dump everything into expenses. When that happens, you lose visibility into whether jobs are profitable. If you don't know your gross margin, you're bidding blind. Let's talk about gross profit, your health check. So gross profit basically tells you, are your jobs profitable before your overhead? If your gross margin is strong but you still don't have money, the issue is probably overhead. If your gross margin is weak, you're underbidding, overspending, or not tracking job costs properly. This one number can change your business. We move on down to operating expenses, which is basically your overhead. These are things like office salaries, admin, rent, insurance, software, marketing, maybe some vehicle costs, accounting, legal. These are costs to run the business, not to produce a specific job. And here's what many contractors do wrong. They let overhead quietly grow. They hire a project manager, then another admin, then upgrade software, then increase office space. Their revenue grows, but their overhead grows faster, and that crushes profit. After subtracting overhead from gross profit, you get a net profit. This is what's left, and this is what you actually keep before servicing your debts. Healthy construction companies actually net somewhere between 8 to 15%. If you're netting more, all the better. If you're netting somewhere, say, between 2 to 4%, you're one bad job away from a disaster. And this is also, the net profit is the number closest to what your taxable income would be. And mind you, after all this, after the net profit, you still have to service your debts. So the net profit would have accounted for any interest expense, but any principal reduction in any debts you may have would not be accounted for in the income statement. That would be a reduction in liabilities on your balance sheet. So I get a lot of contractors asking me that if I'm profitable on paper, why do I not have more cash in my bank account, or why is my cash going down? And a lot of times the answer to that question will be that they have debts that they're servicing, which is mostly recorded as a reduction in liabilities on the balance sheet and not the income statement. So all that being said, how should you read your income statement? Every single month, look at revenue trend. Is it growing or shrinking? Look at your gross margin and the rate. Is it consistent or dropping? Look at overhead. Is it increasing faster than revenue? And finally, look at your net profit. Is it healthy or razor thin? And don't just look at 1 month. Compare month over month, year over year. Your income statement isn't just a tax document. It's a decision-making tool. You can't fix what you don't measure. So final thought, if you're feeling stressed, you're working nonstop, if your bank account doesn't match your revenue, your income statement is trying to tell you something. The contractors who win long-term aren't just great builders. They understand their numbers, they know their margins, they control overhead, they price with confidence, and that's what turns a contracting job into a real business and helps you scale. So I hope you found this helpful. If you have any questions or need help reading your income statement, please feel free to book a time. Our calendar link is down in the show notes, and see you in the next one.